right, well, let's get into the world of credit. Frank Daniela joining us from MA Financial. Frank, good to see you again.
Good to see you.
Now, I'm just reading here that you have recently claimed that now is the best time for credit investing in a generation. Why do you say that?
I have claimed that, Andrew, and it does seem a little bit odd in an environment when many people are talking about rising rates potentially causing debt defaults across the market or in some parts of the market, that you would say that this is the best environment in a generation for credit investing. But I do think it's true. And the reason I think that is that I think there are two major structural forces going on that are favourable for credit investment if you know how to play this theme. And those two themes are clearly we're in an environment of rising interest rates, and equally, so we're in an environment where the cost of financing is increasing, and we're in an environment where we're seeing a change in, let's call it the sort of incredible exuberance that we've seen from investors across all sectors of the market that is putting pressure on asset values. So if you think about those two things working together, what you've got here is that interest rates are rising and any asset is just a function of the discounted value of its future cash flows. So rising rates are putting pressure on asset values. At the same time, the cost of financing, not just the base interest rates, but the spread between base interest rates and the level of delivered value that a lender demands for any type of credit to be put out in the market is increasing. And I think this is creating an equity crunch. And that is because you've got declining rates, cost of financing going up, so the margin for an equity investor is being squeezed. However, in that environment, what can happen is that if you are a credit investor, you can be paid a very nice return, potentially even an outsized return for the level of risk you can take in the most defensive part of the capital stack. And I think we're going into an environment that looks like that for quite some time, and which we haven't seen potentially since the 1970s or maybe even earlier.
All right, just before we get into greater detail as to where you can get those returns, then bearing in mind where interest rates are and potentially where they're going, inflation is still running ahead of that though, isn't it?
That's right. And inflation is high. There are parts of the credit market though, even in very strong high quality assets to either high quality borrowers or secured against high quality assets, including in parts of the investment grade ecosystem where you can actually realize returns that are either commensurate to that level of inflation, even out ahead of that level of inflation, and you can do it in a type of asset that actually is relatively low volatility compared to what you're seeing in a range of other traded asset classes like equities and bonds. And so if you're in that part of the capital stack, then you're going to be protected, you're going to preserve your capital through this difficult period of time, and you're going to be well rewarded. All
right, so where then are you seeing greatest potential in the credit market?
The two parts of the credit market that I really like at the moment are firstly what I call asset-backed lending, which are funding well-diversified pools of loans and doing them where the underlying assets are very high quality, investment grade in nature, particularly in the private markets, and that's because in that type of asset there's more demand for capital than there is supply, so you can command better returns, and that's a great place to be. I think the other place that is emerging as an attractive place for investors to put capital are the corporate debt markets. We're seeing huge structural trends away from major banks streamlining their operations, focusing on their core retail business and exiting large parts of their institutional base. That's causing a fragmentation of the lending landscape into the world of private lenders, private credit funds, and other platforms that can capitalize on that space. And there you're actually again getting an outsized return relative to the risk you're taking. You're in a senior part of the credit stack. It's a defensive place to be, and you're in a floating rate asset class, so you're likely to be protected in a rising rate environment.
Are there any parts of the market you would be avoiding at this point?
There are always extremes, Andrew, and so we're always looking for those kind of things. I think there are a few areas to avoid, and perhaps what I should have said is that it is the best time to be a credit investor, but depending on where you're playing, it might very well be the worst time. So it's the best of times and the worst of times, and you have to make sure that you're focusing on the parts of the market that are benefiting from these structural themes that I mentioned, and where you are appropriately, in fact, perhaps even receiving an outsized return for the level of risk you're taking. The parts of the market that I'm concerned about go to a theme that I think's been occurring in the past decade and maybe for a little longer, which I'll call a bubble of labels. And I think that there have been many types of assets that have been mislabeled in the market. There are certain areas of the market where people are saying they're doing something, and they are, but it's a facade. So for example, a large part of the US credit markets, for example, are first lien senior secured loans to technology companies. And so, sure, you might be senior secured, but are you senior secured over a real operating company with sustainable and resilient cash flow? Or are you senior secured on a recurring revenue lend that is actually more like venture capital, and the risk you're taking has been mispriced? So there's things like that I think need to be avoided. And finally, I'd be very cautious about any exposure to fixed rate duration at the moment. That's the reason why you've seen the bond market have its worst year in more than half a century, and it's because people in a low rate environment stretched for fixed rate duration. I don't think there's any reason to be betting on macro at the moment when you can just be in a floating rate asset class.
All right, so that's all based on what we're seeing in monetary policy at the moment. What about fiscal policy? Because of course we had the federal budget last week.
Yeah.
What are the opportunities then for credit, given those policies that are announced? Of course, largely, or the government wants to be of the view that they needed to pull back spending, but they still will be spending in some areas.
That's right. Look, the government's in a tough spot because inflation's running hot, as you've said, and they need to tighten their belt. But at the same time, there are areas of investment that are required in the economy. And if you look at what they're doing, they're trying to incentivize private sector investment into that space. So some of those areas are things like affordable housing. There was a large program announced that relates to some superannuation funds putting capital into that space. But that sort of thing shouldn't be reserved just for large institutional investors. And in fact, wholesale, retail, high net worth investors can also obtain access to that kind of space. I think that being in the world of providing capital to fund growth opportunities in some of these high quality areas where investment needs to occur and is occurring on a sort of structural or secular thematic, like affordable housing, like the transition to renewable energy, for example, like some of the onshoring themes that we've seen, so the need for ongoing business investment, capex investment, particularly through a more volatile economic period, are actually exciting places to be. And look, of course, I'm biased being a credit guy, but I would say the best way to obtain access to that theme is actually to do it through the credit, because there you don't have to bet, if you will, on winners, but you can make sure that you are capital protected, you've got good asset backing, you're getting exposure to those positive themes, potentially with some sort of optionality around upside if things go right, but your capital preservation elements of the structure are there, and it will mean that your capital is protected through that period of time.